Namaste, welcome to Arthaniti. Few days back, I had posted a video about tax implications for NRIs when they sell residential property in India. Now, I had received many comments suggesting that I put up a video with numerical examples for better understanding of the subject. So, here I am attempting to do that. Here is a short explanatory note with solved examples so that you understand the subject better. Now, in this video, we will answer three questions. What is capital gains tax? How is it calculated? And capital gains tax implications for NRIs. Okay, so we'll start with answering the first question. What is capital gains tax? Well, capital gains tax is a tax on any capital gains that is made by the seller of a capital asset. Now, what are capital gains? Say the selling price of the capital asset and the purchase price of the capital asset. The difference between the two, if the selling price is higher than the purchase price, the difference between the two is the capital gains. So, capital gains tax is a tax on that gap, on that difference between the selling price and the purchase price of the capital asset. Now, there are two types of capital gains taxes that are charged. Depending on the period of holding of the capital asset, you are either charged long-term capital gains tax or you are charged short-term capital gains tax. If you hold the capital asset for more than 2 years, long-term capital gains tax at the rate of 20% plus surcharge plus cess will be levied on the gain that you make. Now, if you hold the asset for less than 2 years, short-term capital gains tax plus surcharge plus cess will be levied on the gain that you make at the time of selling your residential property. Correct? Now, we'll answer the second question. How are capital gains tax calculated? Now, for long-term capital gains tax, the formula is simple. Final selling price minus the indexed cost of acquisition, add to it the indexed cost of improvement, and add to it any transfer cost transfer cost in the sense lawyer fees, registration fees at the time of execution of the sale deed. Yeah, so any such costs that are incurred at the time of transfer of property can be deducted from the final selling price. The difference between the final selling price and the total of these three components is your capital gains. That is tax at 20% plus surcharge plus cess. Now, here what you have to know is indexed cost of acquisition and indexed cost of improvement. Now, what is indexed cost? Well, indexed cost means inflation adjusted cost. Okay. Now, say for example, you have purchased a house, say in the year 2000. Now, CII for the year 2000 is say 100. You are selling the property in the year 2022. CII for the year 2022 is 331. Now, these indices are published by the Direct Tax Department every year. CBDT, Central Board of Direct Taxes, publishes these indices every year. Correct? Now, say for in the year 2000, the purchase price that you paid for buying the house is 30 lakhs. And your selling price in 2022 is say 1 crore 10 lakhs. Now, if you do not adjust the acquisition price, the purchase price for inflation index, the difference between your selling price and your purchase price is 1 crore 10 lakhs minus 30 lakhs. So, you will have to pay capital gains on 80 lakh rupees. Correct? That will be a huge sum of money. Alternatively, what provisions that are given in the Income Tax Act. As per those provisions, you can adjust the 30 lakh rupees for inflation index. Now, how do you do that? You take the CII for the year in which you are selling the property, which is 331, divide it by the CII for the year in which you had purchased the property, which is 100, and multiply it with your purchase price. Now, what this gives you is 99.30. So, inflation adjusted cost of acquisition will be 99 lakh 30,000, and you will have to pay capital gains on 1 crore 10 lakhs minus 99 lakh 30,000. This is going to be your capital gains. So, your capital gains will be 10 lakh 70,000. On this 10 lakh 70,000, you will have to pay tax at long-term capital gains tax rates, LTCG, correct? So, index cost of acquisition is inflation adjusted cost of acquisition, which helps you lower your capital gains and your tax liability. Likewise, index cost of improvement is also taken into consideration, and the cost of transfer. This is how capital gains, long-term capital gains is calculated. Now, short-term capital gains, as I told you earlier, is when you sell the property before completing 2 years after purchasing it. Now, in case of short-term capital gains, the calculation again is there is no indexation benefit in case of short-term capital gains, and the formula is the same: selling price minus your purchase price plus any improvement cost that you have undertaken plus cost of transfer. It is the same minus the indexation benefit. Now see, depending on the value, I told you earlier that long-term capital gains tax is 20% plus surcharge plus cess, and short-term capital gains tax is 30% plus surcharge plus cess. Again, depending on the value of the property. Now, if the value of the property is 50 lakh rupees or less, the tax applicable is 20.8%. These are long-term capital gains tax rates. If the property value lies between 50 lakhs to 1 crore, the tax applicable will be 22.88. How are these tax rates changing? Because of the different surcharge rates depending on the valuation of the property. These rates are prescribed by the Finance Ministry in the budget every year. Now, till the last year's budget, the rates were as high as 37%. But in the budget of 2022, the Finance Minister has capped the highest surcharge at 15%. Right? So, if the value of your property stands between 50 lakhs to 1 crore, then it will attract 22.88% of long-term capital gains. And for any property which is valued at 1 crore and above, the tax rate applicable is 23.92%. So, the highest rate at which long-term capital gains tax will be charged is 23.92% for any property which is valued at 1 crore and above. Right? These surcharge and cess rates are same for long-term as well as short-term capital gains tax. Now, for example, say an NRI is selling the property for 75 lakh rupees after holding it for 5 years. So, the rate which will be attracted is for the tax bracket 50 lakhs to 1 crores. And since it is being held for more than 2 years, it will attract long-term capital gains tax. Correct? Now, See, ideally, what happens is the buyer who is buying the property has the liability, has the responsibility of deducting the TDS before transferring the final sale value to the seller. Okay, the responsibility is on the buyer of the property. Now, how much tax should the buyer deduct at source? The TDS that the buyer should deduct at source. Ideally, he should deduct tax on the capital gains that is made. How are capital gains calculated? We had seen earlier. So, ideally, on those capital gains, the buyer has to deduct TDS and file a return and deposit the money with the income tax department. Correct. But in case of NRIs, what happens is computation of the capital gains cannot be done by the NRI himself. It has to be done by the income tax officer, the assessing officer, where in which particular income tax circle your PAN card or as per your house address on the PAN card, you will have to approach the income tax assessing officer and request the assessing officer to issue Form 13, on the basis of which the buyer will deduct TDS. Okay, now what happens is the income tax officer will calculate your tax gains. It will, the officer will see your tax liability from any other source if you have income in India, and the tax that you pay from that source, the tax bracket into which you fall, your overall tax liability, and the tax gain that you have you will make from the transaction of selling the property. The income tax officer will issue a certificate, a tax exemption certificate, on the basis of which the buyer will deduct lower or no TDS at all. So getting this certificate in Form 13 is a must. Otherwise, TDS will be deducted at higher rates by the buyer of the property. Now, if you fail to get this certificate, if you do not apply and if you do not get this certificate from the income tax department, TDS will be deducted by the buyer, not on the capital gains, because the authority of calculating that capital gains is on your income tax assessing officer. Correct? So, in case the certificate is not procured, the buyer will deduct TDS on the whole of sale value. So, if the property of 75 lakh rupees is sold, the buyer will deduct TDS on 75 lakh rupees if this certificate is not procured from the income tax department. Now here, the example that we had taken is the house was the sale value was 75 lakhs and it is sold after 5 years. So it will attract long-term capital gains tax at 22.88%. So this 22.88 is what will be charged on the whole of sale value of 75 lakhs, and a TDS of 17,60,000 will be deducted by the buyer and deposited with the IT department. Now these sums are huge, correct? So like in order to, it is more than like almost 25% of your sale value will have to be deposited with the income tax department. So it is very, very crucial that you apply for this certificate in Form 13 and get it from your income tax assessing officer, so that lower tax or nil tax is deducted on your transaction. Now, if tax is cut, what is the way out? Should you let go of the money? Well, no. You can file a return at the end of the financial year and claim a tax rebate for any extra tax that is being paid on your transaction. Correct? So, that is what you will have to do to get your money back. Now, tax exemption. How can you reduce your tax liability? Well, by investing in a new house in India, you can purchase a new house, a residential property, either 1 year before the sale deed of your house is executed or 2 years after you have sold your property. So, within 1 year prior to the sale and 2 years after you have sold the house property, you can invest the gain part, the capital gains part in a new property and claim deduction under section 54. Okay. Now, you can also invest in an under construction property, but that has to be completed within 3 years from the sale of your old house. So, that under construction property should be completed within 3 years and you cannot sell that property 3 years hence. Understood? So, if you sell it after it has finished its construction, if you sell it immediately, this exemption that you have got under section 54 can be revoked by the income tax department. One more way out of this is by investing in capital gain bonds. Now, capital gain bonds are bonds in specific entities which are mentioned under section 54EC of the Income Tax Act. Now, any capital gains that you make on sale of your residential property can be invested in capital gain bonds, say of National Highway Authority or Rural Electrification Corporation. These entities are specified under section 54EC, right? And what happens is you need to invest this money within 6 months of your sale transaction. There is a lock-in period of 5 years for these bonds. It gives you a rate of interest of nearly 5.75%, and the maximum amount that you can invest in these bonds is 50 lakhs of rupees. So, capital gains up to 50 lakh of rupees can be invested in such capital gain bonds. You cannot take loan on the amount that you have invested in these bonds. You cannot withdraw it before the expiry of the lock-in period. So, that money is locked in for 5 years at 5.75% rate of interest. The interest that you earn on such bonds is taxable. It is not a tax-free return that you get on these bonds. So, any interest that you earn will be taxed under income from other sources in your income tax return. So, these are the various ways in which tax implications affect your transfer of property in India. Now, I hope the examples that I have given and this short explanatory note has simplified the matter more. And again, any queries that you have, please feel free to comment below the video and I will try my best to solve them. Thank you. Until next time, goodbye.